If you had put $10,000 into gold at the start of 2025, right now, today, that would be worth over $16,700. Not in 10 years. Not in 5 years. In 1 year. And here's the part that should actually scare you. One of the most powerful investors on Wall Street says that kind of gain is not good news. Stay with me. Segment 1. What is actually happening? As of this morning, April 26, 2026, gold is trading at $4,709 per ounce. Let that number sink in for a second. 1 year ago, gold was sitting around $2,800 per ounce. Today, it's $4,709. That is a 67% gain. In 1 year. For context, the S&P 500 returned about 17% in all of 2025. Gold nearly quadrupled that return. Now most people hear that and think, great, gold is winning. Time to buy. But Ray Dalio, the billionaire founder of Bridgewater Associates, one of the largest hedge funds on the planet, he looked at that same number and he called it a warning sign, not a celebration. A warning. So what does he know that most people don't? That's exactly what we're breaking down today. Segment 2, the pattern history is showing us. Here's the thing about gold. It doesn't just randomly go up. Gold surges when people stop trusting something. In 1933, the banking system collapsed. Banks failed everywhere. Unemployment hit 25%. 1 in 4 Americans had no job. People panicked and ran to gold because they didn't trust banks anymore. What happened next? The U.S. government devalued the dollar by more than 40% overnight. Gold prices jumped instantly from $20 to $35 per ounce. The dollar lost value. Gold held it. Then in the 1970s, inflation surged to nearly 14%. Your savings were losing value every single month, just sitting in the bank. So investors ran to gold again. Between 1970 and 1980, gold surged 20 times. 20 times. Both of those moments had one thing in common. People stopped trusting the system. Gold just posted its biggest annual gain since 1979. Ray Dalio is publicly saying this surge is not just a trade, it is a symptom of something cracking beneath the surface of the economy. And the chart he keeps pointing to is the one that compares gold to U.S. government debt. Segment 3, the debt problem. Nobody wants to talk about right now. The United States government owes more than $38 trillion in debt. $38 trillion. And here is the number that should stop you cold. The total market value of all the gold in the world is also approaching $38 trillion. For the first time in modern history, gold's value is catching up to U.S. government debt. That has never happened before. And the reason it's happening is actually simple once you understand it. After the 2020 pandemic, the government printed trillions of dollars to keep the economy alive. All that new money flooded into stocks, crypto, real estate, and gold. But here's what's different now. Even after all the printing slowed down, the money supply has started rising again. More liquidity, more dollars in the system. And as Dalio explains, when you have that much debt and you need to sell even more of it to keep the lights on, buyers start asking questions. Foreign governments, central banks, sovereign funds, they are all quietly asking the same question right now. Do we really want to hold more U.S. dollars? Or do we want something that no government can print? And the answer they keep landing on is gold. Segment 4. What central banks are doing right now. This is the part that most financial news completely ignores. It is not just regular investors buying gold right now. It is governments. For decades, central banks around the world were buying between 400 and 600 tons of gold per year. Steady, consistent, normal. Then something shifted in 2022. Central bank gold buying crossed 1,000 tons per year, and it has stayed there. That is almost double the historical average. Why are they doing this? Simple. They want to reduce their dependence on the US dollar. Gold has no counterparty risk. No country controls it. No government can default on it. It just holds value on its own, and we can already see the results. Back in 2021, gold made up only about 13% of central bank reserves, while US dollar debt holdings were sitting at 28%. By 2025, gold reserves had climbed to nearly 24%. Dollar holdings came down. Governments are slowly moving away from dollars and moving toward gold. Goldman Sachs sees this and has set a price target of $4,900 for gold by end of 2026. Citi analysts are even more aggressive. They have raised their short-term gold target all the way to $5,000 per ounce. The question is, what does all of this actually mean for you? Segment 5. What happens next here is where things get really interesting. Gold just had its first weekly decline in 5 weeks, down about 2% this past week. Why? Because there are hopes that US and Iran talks might restart. If geopolitical tensions ease even slightly, gold pulls back. That is normal. But here is what the smart money understands. The gold story in 2026 is not just about the war in the Middle East. That money supply pressure does not go away after a ceasefire. Second, central banks are not going to suddenly stop buying gold because 2 countries sign a deal. That is a multi-year structural shift that has already begun. Third, regular investors, you and me, are still barely in gold. Goldman Sachs ran the numbers. Gold ETFs represent only 0.17% of private financial portfolios in America. For every single basis point that retail investors increase their gold allocation, Goldman estimates gold prices rise another 1.4%. The institutional money is already positioned. The retail money is just starting to figure it out. That gap is where the next move comes from. Look, I am not here to tell you the economy is collapsing tomorrow. What I am telling you is what the data actually shows. Gold at $4,709 today is not a random number. It is the result of governments printing trillions of dollars. A US debt pile that has crossed $38 trillion. Central banks quietly moving away from dollars. And some of the sharpest investors on the planet repositioning into hard assets. Ray Dalio said it clearly. When trust in the monetary system weakens, gold becomes money again. We have seen that movie twice before. 1933, 1980. We may be watching the opening scenes of it right now. The question is not whether gold is going to $5,000 per ounce. The question is, are you positioned before it gets there? Think about that. And if this breakdown gave you something real today, something most financial news will never tell you, hit that subscribe button. Because this is just the beginning of what we cover here. This is Stock Edge Analytics. See you in the next one. This video is for educational and entertainment purposes only, not financial advice. Always do your own research before making any investment decisions.